saying, I want soybeans yesterday. That's what the world's saying right now.
Okay.
Right.
Thank you, Emily.
Thanks.
Yes. Okay. We've got one more question.
It's not a question.
I'll be at dinner tonight, by the way.
I just wonder, because right now we are talking about an influx of the capital for the next year from the U.S. government. And I think you mentioned as well about the weaker dollars that we are going to face somehow in the future. And I wonder, as a fund manager who seems to manipulate the market in a sense, yeah.
Who manipulates?
The hedge fund.
Oh, I don't, the word manipulation
I just wonder if next year, if the bank gives you a huge amount of money, yeah, for a short term with a low interest rate, how are you going to allocate the asset, you know, between the housing market, the treasury bonds, or put into the commodities, you know, and play it like an oil market? Sure.
Well, again, let's just talk about grains and oilseeds, because that's really what we're talking about in terms of, you know, the amount of money invested in grains and oilseeds from hedge funds, from banks, is minuscule compared to what's in crude, or what's in the energies. Okay, if you look at just for example, if you look at the Goldman Sachs, or now the S&P 500, that index, that's 75% weighted energy. Okay. I think that most of the funds that I advise, most of the banks I advise, they have recognized that they don't have to have very large positions to make a very nice return or to lose a shitload of money. Like, it doesn't take a very big position in this market to either make a nice return or get your face ripped off. So I think that in itself is kind of reducing the flow. But I think in general, whether it's static money coming into agriculture investments, or buying equity shares, or equity plays vis-a-vis agriculture, or trading futures and options, I think there's more money coming into the segment rather than leaving the segment. Okay? Does that answer your question? But it's not manipulation, okay? No, really. I mean, if you don't have speculators, you can't make a market. You've got to have both sides. Okay, you've got to have liquidity. And guess what? You know, the world is pretty real-time information, and it's pretty transparent, and we're all dealing with the same facts and figures and numbers and nuances. And it's about, you know, relationships, and it's about who's providing you the information, and you know, that type of thing. So.
Okay, and we just have barely just time for one more question.
Oh.
In the back.
Emily, that was a very interesting topic on the spreading, on the bull spread, on the soya corn, or on the particularly soya. September, we pulled out a chart last week on the December soybean meal, and it was trading like in the range of like -2 to 92. Couldn't recall what particular period of spread trading at the time. Sure. But my question would be what would be the likely scenario when the September soybean meal expires in the next week or so? Because you mentioned that what we have noticed of late was that spread always collapse at the time of market going to expire. Right. Because it looked to us, it's more representing the speculative acts than a real tightness of physical soybean or soybean meal. Okay. in the U.S. Because CBOT does represent a U.S. market trade. So, what questions really is what would be the likely scenario of spread soybean meal September, December? Sure.
Okay, so the SEP-D spread. Let's step back and say, first and foremost, you're in a delivery period. Okay, and this is when people get a little confused on the speculator and the hedge funds, and are they manipulating? Most people are actually that are trading paper, if you will, are out of the SEP. They don't go into delivery. I don't mess around with delivery. I tell most of my people that I'm not smart enough, and I don't have deep enough pockets to fund those type positions. So actually, typically, that when you get into the delivery period, that's much more on the commercial side. I think if you looked at soy meal premiums in the Western Corn Belt, they went from 50 over to 100 over. Okay, the meal market in the U.S. is, one, it's extremely volatile, and two, it's very, very tight. Okay, it's very tight. So when the SEP goes off the board, will that spread probably collapse? Maybe, but the big issue with the September is that it's not delivery grade. Okay, it doesn't make deliverable spec, so you don't want to ever be short that spread, because if you were to have to deliver, you couldn't make delivery. And that's why a lot of people don't mess with the August or the September meal upon expiry. But I would argue that what you're seeing in the September, if you look at September deck, that spread, you're at $330, call it $330 in the SEP. Deese is at $280, so what's that, $53? Right now, the AUK Deese is an $8 inverse. I don't see a reason why you wouldn't actually see a replication. Like two funds that trade they've been buying October meal. Okay, some people are buying October meal, selling December meal because they don't want the outright exposure, because they do think the inverse is going to continue to roll forward, which actually I do agree with. Because again, it's not like we have any more fresh beans hitting the pipeline until we start harvest. So that meal situation in the U.S. is exceptionally tight, but that the basis is going to be extremely volatile, because none of the processors want to get caught carrying a lot of cash beans without having that meal sold in an inverse, which is what we have, and a very sharp one at that. So we've got about 4 to 5 more weeks dealing with this situation in the U.S.
Okay. Thank you, Emily.
Thanks.
Excellent message.